When it comes to unsecured funding, a lot of investors who are seeking to raise gap funding, they want to know what's the best option, unsecured term loans or lines of credit. So in this very short yet informative video, I just kind of want to briefly unpack the difference between the both and give a short pros and cons list as far as which would be best depending on the situation. So when it comes to unsecured term loans, we already know that a loan is just simply a lump sum of money that gets deposited into either your business or your personal bank account, and you have liquidity that you can deploy at your disposal. And this is a really great option for real estate investors who simply need the liquidity and the cash to close so that they can leverage other people's money and acquire a property, whether it's for a fix and flip or even an investment property. On the other side of things, you have lines of credit. Now when I say lines of credit, this could be in the form of credit cards, or it can even be a traditional line of credit that you may get from a small bank or a local credit union. Essentially, the way that works is it gives you a lot more flexibility as far as how you deploy your capital. Especially if you're doing a rehab, for example. Let's say you've already acquired the property and you're going into the rehab portion of the project. In case you go over budget or you run into any unforeseen contingencies, can't imagine that happening, you already have lines of credit, whether once again it's in the form of credit cards or business lines of credit that allow you to quickly take care of that problem, whether it's an overflowing budget or something going wrong with the property. That way you can take care of the issue and you have that flexible option of being able to deploy capital if need be, yet you're not paying principal and interest on a much bigger loan balance. So they both have their upsides. On one hand, you can utilize a term loan. You have a lot more liquidity, so it's easier for you to qualify for loans and have the cash to close so that you can leverage other people's money. The downside to that is, of course, you're paying principal and interest on a much larger balance. And when it comes to lines of credit, it gives you a much more flexible option because you have access to capital at your disposal and you can use it at your discretion, and you can determine how much you want to use and you only pay on the amount you borrow against. However, if you do find yourself in a situation where you need a lot of liquidity very quickly, you're going to have to orchestrate the logistics to pull that capital from those lines of credit, and it may be a little bit costly and it can also slow you down. So at the end of the day, which one is the best option? Well, it depends. It depends on your strategy. It depends on your own financial model. But at the end of the day, if you're able to qualify for both, I'll say go with both. You're gonna have the option of having liquidity, and you're also gonna have the flexibility that comes with traditional lines of credit. So if you're an investor and you're out there and you're looking for unsecured funding, whether it's to bridge the gap so you can get into a fix and flip or a buy and hold, and or you just need more flexible options as far as having working capital, please do not hesitate to reach out to me, 706-536-3598, or you can also shoot me over email at joseph@powercapitalsolution.com. And even better, feel free to simply click the link below or above, whichever platform you're watching this video on, wherever the link is, click on that link. It'll allow you to go ahead and fill out the form, and we can easily give you a funding projection as far as how much you qualify for within 24 hours or less. Make sure you like, comment, share. Happy investing.